Well, on unexpected lines, Indian steel companies reported their strongest quarter ever. Now, their EBITDA per ton, well, it surged on a low base on a year-on-year basis, but also saw a marked improvement on a sequential basis. Keep in mind, this is despite the volumes that got hit due to the COVID-19 wave 2. Now, deleveraging on the balance sheet, that took place, and the pace from here on will pick up. Now, in terms of the outlook for Q2 FY22, well, it's looking up for steel companies. That's because steel prices are up on a sequential basis, though coking coal costs, they've gone through the roof. So that's what will limit gains. The deleveraging story, though, will continue for most of the biggies, barring JSW Steel, owing to their recent acquisition and also their capex plans. But China, that's the joker in the pack, as it's the world's largest steel producer. Though the measures that have been taken by China, well, they have been positive. Remember, they cancelled export rebates on steel products. That was earlier this year. Additionally, reports indicate that there could possibly be a levy of export tax. Now, that will be the big structural positive for Indian steel companies. And that's what could drive a strong case for re-rating from here on. Now, one can argue, well, Chinese steel exports, they have halved over the last few years from around 100 million tons just around 5 years or so ago. The bigger point, though, is that China is still a big factor because it accounts for around 25% of world steel trade. So this is what will create a material deficit in the ex-China steel markets. Now, the key focus for the second half of 2021 will be on Chinese steel production. And in the month of July, well, that did see a contraction of around 7 to around 8%. That is the encouraging sign that the street was waiting for. Keep in mind, Chinese authorities, they have warned the local steel mills out there to maintain their crude steel production below the 2020 level. Now, to meet this criteria, well, Chinese steel production will have to be lower by nearly around 52 million tons or around 11% on a year-on-year basis for the remainder of 2021. Why is China doing this? Well, China wants to reduce carbon emissions by limiting production of crude steel, and they also are focusing on meeting domestic demand by incentivizing imports and discouraging exports. Now, valuation-wise, well, the stocks listed here in India don't look very, very expensive on FY22 basis. But the street is nervous on the sustainability of these numbers and whether or not that structural change is taking shape. Now, that's evident because if you pull up the FY23 numbers, well, the street is factoring in a sharp reduction in the FY23 EBITDA. The key reasons include the market saying that, well, there'll be a sharp decline in terms of steel prices from here on, and that will be coupled with higher steel cost. In some cases, the street is expecting the EBITDA per ton to be half of what we saw in the past quarter. That's Q1 FY22 odd. Well, the street will be pleasantly surprised if China walks the talk, they lower production and they restrict exports. Secondly, if there's a shallow than expected steel price correction, well, that will be music to the ears of the bulls. And what could really boost market capitalization is faster than expected debt reduction. Well, the risks obviously are on the table as well. So let's bring that up for you. Higher steel production coming out of China, and also maybe some of these domestic guys at times when they make more money, they spend more on irrational capex or maybe some large acquisitions. So take note of those factors as well.